In the last video, we saw how liquidity providers can deploy various strategies and optimize for the current situation and their goals. On the left are the less riskier strategies, the leftmost being holding on to the stable coins. No upside, minimal upside, right? No, you're not earning any fee, nothing like that. The value remains the same. Next is you hold on to the assets in 50-50 ratio. Maybe you hold on to ETH and USDC in 50-50 ratio, or it could be both, like any type of assets and all. Other is you hold on to 100% of the assets, right? Like maybe you hold on to 100% of the ETH. That has a higher upside, but is exposed to more risk also. If the prices go down, then you're exposed to more risk. Then you provide liquidity over a wider range. You have better upside because then you're earning fees. You are putting your money to work and you're always constantly earning fees from it. But you're also exposed to impermanent loss, which is the riskier side. Next is you can choose to provide liquidity over a narrower range where you have high capital efficiency, you get more APY, but then the risk is that you're more exposed to impermanent loss. And then you can also choose to provide liquidity with the volatile assets. Again, the benefits is that you get to keep like quite high percentage uh, of the fees, right? And then again, like the downsides are you're even further exposed to impermanent loss. So again, you can optimize for your goals based on these strategies. So in this video, that what is a strategy simulation? What are the benefits of strategy simulation? We're going to have a look at two tools which you can use to simulate your strategies. Number one is DeFi Labs, and the second is Uniswap Fish. So let's get started with this video. So Uniswap ecosystem provides various tools using which you can simulate some of your strategies and try to see what is your exposure to impermanent loss, right? For how long can you expect your strategy to remain within the range? When can you expect it to move out of range or something like that, right? Whether you should deposit in a wider range, what are the risks and all, that can all be seen using some of the simulation tools, right? So some of the benefits which you see from strategy simulation is you will make an informed decision, right? Whether you should be depositing on a wider range or a narrower range, like the results will be clear in front of you. And then you can optimize for your returns. Optimization of the returns means you would know like how much your risk of exposure is, right? And then you can accordingly you can mitigate your risk also, right? Next is you can understand like the market dynamics. You can see how the prices have been moving, because it all depends, right? There could be two tokens who are always moving together. In that case, the risk is limited of the impermanent loss. But if the two tokens, they have no correlation of the prices and all, the risk of impermanent loss is more. So by understanding market dynamics, you can optimize your returns and mitigate the risk also. So this all could be done from strategy simulation tools. So the first tool which we'll look at for strategy simulation is DeFi-lab.xyz, DeFi-lab.xyz, an excellent tool. Click on Uniswap V3 simulator here. So on the left, you have to make various selections. So first is selecting the pool which you want to use for providing the liquidity. Here we use ETH-USDC, which is like the default pool, and then you choose the base token, whether it's USDC or something else. And it could be like you can just invert it. In that case, ETH would be the base token, and then you choose the investment. How much do you want to invest? And next is you can choose various strategies here. uh, V1 strategy, like V3 strategy 1, it is like a narrower range. Strategy 2 is a bit wider range. Like here, strategy V2, which is unbounded V2, is like just like it behaves like V2, you're just depositing the liquidity over the entire range, right? Least capital efficient, but like less exposure to impermanent loss in that case, right? Next is you're holding on to the 50-50 of the assets, 50% ETH, 50% USDC. Other is holding on to 100% ETH or holding on to 100% USDC. And here you see what are the daily volumes, right? Like the transaction volumes and all. And what is the TVL, right, for that pool, and how that's varying by each date. So let's try to select like few of these strategies and see how they compare with one another. So we have selected like all the strategies, and from this graph, I think this graph is a very important. Here you can see like what would be your exposure to impermanent loss and what would that would be the asset value. as the price of ETH increases, right? So if you're adding on the liquidity within this range, if the price increases, then like I think it's 19. Let me just increase the size, right? This is 1850. So if the price, like suppose this is still 1900, if the price increases, then this, right, 1933, in that case all your ETH would be converted to USDC, and this is the maximum amount which you'll be left with, right, till here. And this would be the maximum like USDC amount that you'll be left with, because all of your ETH and USDT would be converted into one type of asset, which will be USDC. In case you are depositing it to wider range, right, this is the wider range. If it increases again, like this is the maximum, like all of your tokens will be converted to USDC, right? So from here you can see what would be the maximum value of your assets with this price, right? And if you're holding on to 50-50, you see, okay, how, what would be your asset value and all. And this is like 100% holding on, like to ETH, right? As the ETH price increases, you see a linear increase in your profits or linear increase in the value. And this is 100% holding on to the USDC. There is no decrease or increase; it all remains constant. Right? So by using these strategies, you can try to optimize. You can try to see what would be your asset value. In this case, you see USDC and all, but if you take two volatile assets, you can try to see like two assets which have different market conditions, right, whose price changes and all. You can try to gauge that what would be your maximum asset value if the price changes, right, of one of the assets. So here you, for both of these strategies, you can try to see that what is the concentrated liquidity multiplier. In the first case, you're providing more concentrated liquidity, which is equivalent to, so 56 times like higher capital efficiency as compared to V2, right? And in the second case, like it's a wider range, but still 28 times more uh, uh, concentrated liquidity as compared to V2. And then you get these token ratios and all. You can also change from here, like if you want to increase the range and all, you can increase the range, and then the strategy would be like, or the graph would be updated accordingly. So here is the price breakdown of each of these strategies. You can see like after this value, your entire money would be converted to USDC, like quantity is USDC. Below it, everything would be ETH, right? If the price is dropping, everything would be ETH and all. So here you can compare risk, like which is impermanent loss. You can compare the strategy one with holding 50-50, holding USDC, because if you're holding on to USDC, right, the value decreases, right, your difference is also increasing, means you're exposed to like more impermanent loss in this case, right? But if you're holding on to USDC, your value is not decreasing and all, right? And again, if you're holding on to 100% ETH, right, if your price is increasing, right, your impermanent loss is increasing, because in this case, if you would have held on to ETH, you would have got more money, right? But here, like after after your range, your entire amount of ETH would be converted to USDC, so your exposure to impermanent loss would be more. So this is how you can use strategies, and you can compare like various strategies to measure like what your risk profile is. So here we take our next example, in which the pool is ETH and Matic, right? Again, you can select here, you can choose the pool which you want to, right? So here I go to Polygon, and then I want to choose which tool I want to use, and it was Matic and ETH. You see what's the fee tier and all, right? And there are two fee tiers for Matic and ETH. So you could try to choose any one of these, right? And you can see what is the total value locked in each of these pools. What is the 24-hour volume? 24-hour volume in case of 0.05 fee tier is much more as compared to the one with 0.3%, right? Uh, so again, like here, your ratio of the funds would be less, and you'll have a lower fee, but also the trading volume is a lot higher, right? So the fees that you'll earn would be a lot more. And then you can also see like what were the fees that were collected from each of these pools, and accordingly you can measure like what your ratio would be. So let's select this Matic ETH here. So here again you see all of these different strategies. Uh, One thing which is very important to note is that the prices are shown all as base token as Matic, right? They are not base tokens to USDC. In this case, the base token is Matic, and all the strategies, if you see like here, this is 100% holding onto the Matic, That's why the matic price will remains constant, and then you see like as a straight line, right? And a horizontal line. But actually, in case like if you compare it to USDC, the price is still fluctuating, right? So all of these graphs, they are represented with the base token as matic. All of these prices, as you can see over this tooltip, all of these prices are in WMATIC. So very similar to the last scenario, you can try to see all of these strategies. You can see how they get impacted with with the very similar results, and then you can see your exposure to impermanent loss and test out various strategies. So the next tool which we can use for strategy simulation is Uniswap Fish. Excellent tool. Again, like you can select the network, you can select the pair. Here we'll try to select the same pair, which is USDC and ETH. And then here it shows you like what percentage of the users that add the liquidity, like what percentage select. So 77% select this as the fee. And let's calculate, which is like simulate the strategy. So here if you're depositing $1,000, you earn this much fee, right? And you can just see like, okay, if you're adding more money and lower money, like, and if you increase the range, you can see your fees are decreasing as you reduce the range and all. Your fees keep on increasing, right? Because your capital efficiency is increasing. So as you become the narrower the range, the fees you earn keeps on increasing. But again, you also have to remember that your exposure to impermanent loss is also more. And if the price moves out of the range, then in that case you'll not be earning any fee, right? So it is important that when you're adding the liquidity to make sure that your liquidity is active and the price remains within that range for you to keep earning the fee. And you can also try to see the prices, try to see okay, like if it will go out or not by just looking at these historical prices and all. And from this tool itself you can try to create a position. I myself have not used this tool to create a position, but I've used it to analyze the strategies and all that and see what would be the estimated fees that I'll be earning.